following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
And with that, I think we'll welcome Brian. Brian, how you doing?
Hey, I am so sorry. I was supposed to be on here 20 minutes ago, and I am just bad at my calendar. I rely on calendar reminders, and I didn't set one apparently. So
well,
I'm doing well otherwise. Sorry for not for seeming like a no-show.
No, that's okay. That's not a problem. We're pretty easy going. So Brian, it's great to have you on our live stream. This is something we're relatively new doing with this 3-hour live stream. So we're still stretching our legs and getting our feet. But for this is your first time on the show, I'd like maybe if you could give a little bit of an intro about what you do and even where you're located. I think people really like to hear that.
Yeah, sure. I'm currently, and have been for the last close to 30 years in Denver, Colorado. So I moved here actually in 92, so more than 30 years. I moved here after graduating college in 91. In 91, I went on to be a retail stockbroker. Started with a little penny stock firm called Thomas James. Lasted there a couple months just because I realized, what they were doing wasn't honest. So I went over to Lehman Brothers, and that was really good because I learned two things there. One, I learned how to sell. I'm not a natural salesperson and don't enjoy the sales process, but I learned how to sell. So that was good. And then secondly, I was partnered with a senior broker who was, he did a lot of technical analysis. So that really got me hooked. I had previously read Stan Weinstein's book, and what he would do is match earning surprises with a chart. So line up the fundamentals with the technicals. And, he was the top producing broker in the Boston office. So I learned a tremendous amount from him. Went to Tucker Anthony and was a broker there for about a year and then moved out to Denver. Like I said, I think in 92, I was a broker here for a little while and then opened a day trading office in downtown Denver, and have been, active trader, full-time trader since then. 2008, I wrote my first book, Technical Analysis Using Multiple Timeframes. And last year published the Anchored Volume Weighted Average Price book. So that's it, kind of in a nutshell.
That's it. That sounds like a lot. Writing 2 books is not an easy task, but we appreciate you coming on and sharing your knowledge with us. So you got there when the Rockies debuted.
Yeah. And actually they were playing in the old Mile High Stadium before they blew that up and made a new one. So that was interesting, before Coors Field.
That's right. It's Coors Field, beautiful ballpark. Are you a baseball fan or?
No, I'm not. I never watch it on television. Sometimes I'll go to a game and
it's an event more than a baseball game, right?
Yeah, I used to go more when my kids were younger, but they're out of the house. They've been out of the house for a while, and they just moved. Well, my older son just moved to Tennessee, so I won't be taking the grandkids there anytime soon.
Okay. Well, that's great. So VWAP, I think, that is something you're known for now, right? Especially with the publication of the book. And thank you again I'm going to put it up here on the screen. Thank you again for the book. I read it. I'm rereading it. I mean, I'm going back to pieces because there's so much in there that I think any trader could take away from it. I know you use stocks as an example, but futures are right there with it, right?
Absolutely. And I think that, in particular for the S&P, it's important to not only look at the daily volume weighted average price for shorter term traders, but to look at it from the 9:30 a.m. start as well, to anchor, set one there, because oftentimes you'll see that, the market will pull back, let's say, and the anchored VWAP, or the VWAP for the overnight session is maybe 3 points lower than where the market halts. And if you put a 9:30 VWAP on there, sometimes that'll be it exactly. So I noticed the difference between SPY. That's how I kind of figured out you have to look at both, is looking at the SPY on a 1 minute chart and looking at the ES on a 1 minute chart. And you would expect you'd see the SPY VWAP hit perfectly, but it is 2 points lower on the ES sometimes. So, I mean, that's not always the case, but it's good to be aware of both.
So maybe mission control, if we could go to the chart. Here's I generally look at 10-minute charts just because our shows kind of fit that model when we're looking for trades. And here's a 1 minute chart. And we have the ability now, I don't know, coincidentally, I'm not going to say ironically, because there's nothing ironic about software programming, but coincidentally, last month, April, when we were talking, we released for the first time an anchored VWAP drawing tool.
Oh, fantastic.
So we've had VWAP, but you had two choices. It would be for the session or the start of the regular trading hours. Okay, that's great. Reading your book, though, that's just 2 points on a map, really, right? I'm just going to really quickly bring up the tool, and what you're saying is, and I, I've read the book, and it's kind of the way Jim and I have thought about it, which is 9:30 again. There's a reason 9:30 is important, right? Because regular trading hours, but there might be other reasons. We'll talk about that in a moment. But if I go back, and of course I have to drag my chart back to 9:30, here's where we can just pick that 9:30 bar, which really interesting, a little bit of a movement right before the open, and we can just extend it. And I've I've done a little bit of different coloring so we can see it a little better on the show. Here it's going to track a little bit, but not exactly, right?
Sure. And the later in the session you get, the more they will converge, because they're basically, your denominator is so large at that point that they kind of come together.
Right. And I think you mentioned.
Actually, I'm sorry for interrupting, Tom.
Sure.
Yeah, you can see that right there, where your blue one, at first the difference between the two was, several points, and now they're pretty much equal.
Right. Exactly. And that's when volume really comes in. This has got all sessions volume, so it's kind of smoother here. Of course, at the start, this is 1 minute, so we don't usually look at it like this. You got to pull it back, and that gives you a sense of what that would look like, on a longer time scale. I brought in some of yesterday's data, so that's not really fair. But I think your point too that you make, which is really cool, is other ways you can put the VWAP on, right? Which is the way, as a technician or somebody looking at price, you don't have to be a technician. Somebody who follows price, inflections, right? Inflection points are a good place, right? And it could be highs, it could be lows. I'm probably going to have to learn how to use the keyboard shortcuts, because it's probably faster. But you might look at the high here and see, either high to low or high forward, right? And see what that is, right? So now we've got this VWAP from the high over here, which was at 1050, kind of after the opening range. You could probably extend it back here and do this. And that's at the 1030 time period. And so, I noticed in your book, it's almost like, effortless, I think, is the thing I think of when I see all those different trend lines, and they're in there for a reason. And you've made that, right? Like you know where to put these, where we're learning to say, okay, we got to get away from the anchored at the start of the session, anchored at the beginning of the regular trading hours. What other places could you do that? News events and inflection points are like kind of the two natural things I think of.
So I kind of laid out, time-based anchors. So for instance, the beginning of the day or 9:30 for futures traders who want both of those, or week to date volume weighted average price is often really good. I mean, by Tuesday, Wednesday, and Thursday, you start noticing, holy crap, it just keeps touching that and bouncing tremendously. Month to date, year to date, if you look at if you look at the SPY in particular, this rally that we're currently in, that began about 10 days or so ago, bounced precisely from the anchor from the beginning of the year. That's exactly where
Wow.
Bitcoin found buyers on this rally. That's exactly where the semiconductors found buyers on this rally. And this is now where crude oil is trying to find support at its year-to-date anchor. So you've got time-based anchors, you've got news-based anchors, so Federal Reserve announcements are big, CPI, PPI, anything that, gets people to revalue the market quickly, that changes the opinion. So in equities, which is mainly what I'm involved in, earnings reports are fantastic. And then you've got other things, in price base. So you've got, as I said, time, news, and then price. So significant highs and lows, and you've got it right there on that ES. It bounced, perfectly. Some people will say, well, it was this moving average or that moving average. Well, what was it 2 months ago when it bounced there as well?
Right.
Sometimes it's the 20-day, sometimes it's the 50-day. But this is actual, price-based. I view it as the ultimate sentiment indicator. Who's in control from the beginning of the year? Are they willing to defend that? Or is this a place where the buyers are going to lose control? The shorts are going to take control and push it lower. They had their opportunity there, but as it made that higher high a week and a half ago, right there, then, the buyers were 100% back in control, and that's where this rally has come from. So, then you can put an anchor to the beginning of this rally from 10, 11 days ago and start to monitor how it behaves based around that. Is that now going to become a place where buyers show up? Or when will we know that the average participant on the long side who got involved since this beginning of this event loses control? Well, as long as we're above that anchored VWAP from there, it tells us with 100% certainty the buyers are in control. The average short seller is losing money. And if we start to see a battle around that, that, as you said, is an inflection point. I call them a level of interest, point of control, whatever you want to call it. When we see the battle around there, and then let's say prices get stuck below it and it finds resistance there, well, then that signals that the sellers have regained control, and now you can start to, short against that.
Yeah. And that's a great point. We use the longer term charts, of course, as helping us with bias, right? So yep. This is exactly what you're talking about, right? Who's in control? Are we in a seller's or a buyer's environment right now? If we look at this market this year, it's pretty much been an uptrend. Yeah, we had a couple of pullbacks. I don't know if you'd call this 8% correction a pullback of anything notable, but this might be also a place where you could start from the top. We're breaking out of those highs. We're making new highs, but it'd be interesting to see, okay, what happened since the last new high, right? And you can do that. And so now you get these different converging or not converging lines, right? Depending on where you draw it. And you've got different, just like we have different levels of support for certain reasons, you have different levels of support for, I think, good reasons, right? Again, time-based, price-based, and event-based. Fed days, right? Not the 2 o'clock or 2:30 bar on an intraday. That's interesting too, but I think May 1st would be a good inflection point, or June 12th, or whatever the next date is, June 15th, whatever. Those would be good inflection points as well.
And that is that April, high there, or if that was May or whatever. Notice how it acted as resistance on the way down, and especially right there where you're pointing out, it bounced perfectly to that. So
Right.
something I always consider is, okay, we tried to find buyers near the year-to-date anchor, and then we rallied pretty strong from 49.50-ish, let's just call it, to 51.50.
Right.
We're rallied 200 handles, 5%. So you ask yourself in that area, what's likely to hold this thing back? Well, the average long in here is maybe trying to get out even. The average short is maybe thinking, okay, here's where we have to press. We
Right.
bring it down to the year-to-date anchor, and then the next push up, where we had a higher low at the year-to-date anchor, and then we pushed up through it. That gave us confirmation with that higher high in particular, that now that we're above the average price, the average long is making money, the average short is losing money in there. It's the buyer's game to lose. So get involved here on a shorter term time frame and manage your risk for the time frame you're involved, because now's the time to be a buyer. Don't buy those dips where it's uncertain, but where we now have actual math that tells us at 51.46 or whatever it is,
Right.
as it crossed above that VWAP, the buyers with 100% certainty have control on average since the highest point paid ever in this market.
Yeah. And that's a great point. We've got different levels based on different time periods, right? You've got a yearly VWAP. You've got one from the last high. You've got one from the last since the beginning of this trend. The shorter term VWAPs, let's call it, shorter term levels, will hold or not hold, based on that longevity. But also, I think, it is a good way to say, here's a level where buyers are going to come back in, or sellers are going to come in, right? Or they're not. I really like the way you explain it in the book, why the buyers and sellers come in around VWAP, because there's one other aspect in stocks, which is the market makers. And certainly we have that in the futures market as well. I really enjoyed that, because that was the third piece that I haven't really thought about, right? Which is, we think about when buyers buy, they're now sellers buy, they're now buyers. So what happens at these important levels, and why might it reflect versus go through? I think you do this in your 2-day, what is it called? I think the 2-day method. Is that what you're?
Oh, are you talking about the prior day's VWAP?
Exactly. Yeah.
Yeah, I mean, can you pull up, for instance, this morning, Hood, HOOD? That was absolutely just a perfect example of that.
Let me see if
Using,
I can do that real quick.
yeah,
Know why this is. See if I have access to it. Yeah, I don't know if I do. We're pretty much all futures here, Brian.
gotcha. You don't do any equities, huh?
We can get access to them, but it's
Uh-huh.
just we're all futures all the time.
Okay. Well, anyway, so the point is that, let's say you had something, happening the prior day where you had some activity in the stock, and it might have been a breakout or just some large volatility. And then, so for instance, this morning on this one, it gapped up and then it pulled back to the prior day's volume weighted average price initially. So
Okay.
so it gapped up, it pulled back to the prior day's VWAP, and buyers showed up right there. That was pretty much the low this morning in Robinhood, HOOD. And then it got back above today's VWAP. So it says, we gapped up. We initially had a little bit of profit taking, but the buyers defended it from yesterday's average price. And then it gets back above today's volume weighted average price. And this occurred at, about 15 minutes after the market opened. The stock was $18.75. And it never looked back. It's now $20.10 right now. So
Wow.
we've seen a beautiful 10% rally from this point, or 8% rally from that point. And it just, so particularly, on a breakout day, where a true breakout, where you have breakout from a consolidation, where the stock is, where the market has gone sideways a little bit. Let's say it pulled back 3-4 days, went sideways for a day or two, and then yesterday it moved higher. Well, then this morning we see a little bit of weakness, it pulls back to the prior day's volume weighted average price. And when it finds buyers there, it's saying yesterday was the turnaround day in this market, and the initial profit taking saw buyers come in and defend the average price from the prior day. And then it gets back above the daily VWAP. That's when you know it's on. For me, that is one of the lowest risk, highest probability plays in my playbook.
So, in this case, we obviously we can show the previous days VWAP. We would maybe just draw a horizontal line. We don't extend it. We're big fans of looking at important levels from the previous day, right? So obviously the high low close. I never really considered previous days VWAP until I read your book. So that's where, again, coming back to your book and learning a little bit more about it, and kind of it's not just about what happens. It's easy to say, okay, the price should do this, price should do that. To me, that's lazy. I'm not saying you do that. You actually go and explain why that happens, right? What are the market forces? What are the thoughts with the participants? And I think that's what traders need to know, right? If they're going to get into trading, and we have a lot of new time traders, Brian, the first time traders, new traders, rather than looking at a chart and seeing, this should happen, right? Because chart reflects behavior, but actually understanding who the market participants are, what drives them, how they get paid, and what's going to happen day to day, moment to moment, level by level in the market is very important. And once I think you grasp that as a trader, it just makes coming to the chart, coming to your desk, coming to your phone, wherever you trade, a little bit easier. You get a little more confidence.
Absolutely. And people are trained basically like monkeys to recognize patterns. Yes. Right? They look at tweezer tops and candles, which I think I think candles, personally, I prefer bars. I've never looked at a candle and said, hey, that's 3 marching soldiers, I have to do this.
Right.
But if you understand what the candle means, the open versus the high versus the low and the close of the candle, what the psychology of that, whether it's a minute, a month, a week, a year, what that candle is. And then you break it down to shorter term timeframes. One of the examples I like, though, to use is just a simple, let's say, an inverted, or even just a head and shoulders pattern, a head and shoulders top. You have and people look at that and they go, well, that's a head and shoulders pattern. Okay, but what does that mean? What it means is just so damn simple that it means we had a pattern of higher highs and higher lows, and then the market comes down to the prior higher low, and then it bounces and makes a lower high. So instead of higher highs and higher lows, we now have a higher low and a lower high. So if it breaks the lower low, that's where the pattern is considered to be complete. Well, what does that pattern completion mean? It just means that the previous pattern of higher highs and higher lows has now been confirmed. That lower high has been confirmed with a lower low. And that's what your head and shoulders pattern is. Think of it that way instead of just, hey, it's a head and shoulders pattern.
Here's a shape. Right. Yeah. Well, I agree. And I've said this, we're trained you said monkeys, I'll say little kids, same thing. We learn, from kindergarten on to identify patterns, right? And we don't know it. We're not thinking of this, of course, but that's just how our brain has been trained from the get-go, right? Identifying patterns, and you have kids, my kids had the same thing. You're like, oh, wow, I don't remember that exact sheet, but I remember those whole things. Like, finish the pattern. And you don't realize how prevalent it is. And it can be a trap. It can be a trap when you're trading, right? Because
absolutely, yeah.
If you use it as a crutch, and don't understand what's happening, you maybe don't have enough information to understand why that pattern didn't complete. But that's a whole nother topic that I don't think we have time to get into, Brian.
I was going to give you actually a little example of that. So I wrote an article about why you shouldn't use hourly charts for equities in particular.
Okay.
Because the market's open from 9:30 to 4. So you have 9:30 to 10 is a half hour, and then you have 6 full hours. So if you're using hourly charts, what you're actually seeing is 30 minutes from 9:30 to 10 is one bar or candle. Then you have six 60-minute candles. So I wrote an article saying, which one of these doesn't belong? Here's 6 apples and an orange. And it's
Right.
obvious which one doesn't belong. And the point is that first 30 minutes of the day is the orange, and you've got 6 apples the rest of the day. So rather than using 60-minute time frames, you want to use 65-minute because there's 6 of those that are equal. The
Right.
equities are open 390 minutes a day, or 30-minute candles, there's 13 of those. You know, keep doing the math.
That's a great point. That's a great point. You know, we would at a former employee where I was product manager, we would get that request actually kind of to your point. We could do those 65-minute candles, but sometimes they wanted the hour to start from 9:30 to, yeah, they want their 60-minute chart, but they wanted to start at 9:30 to 10. They wanted that hour chart to be 9:30 to 10:30, not 9:30 to 10 and then
But
continue
what
on.
happened from 3:30 to 4? Then you've just moved your orange from the beginning of the day to the end of the day.
That's a whole nother, I mean, that's again, that concept was not there, right? They wanted to
Yeah.
start, they, you know, so um uh, you know, really you could really go down a rabbit hole for good reason on how to handle intraday data. It's so much different than daily data. when
Yeah, I
when I,
mean, I guess you could adjust it for a normalized volume if you wanted to.
right,
But you know what? And that's the beauty of the anchored VWAP is that's what it does, is it normalizes. It doesn't matter. So for instance, when you're looking at futures, I think it's foolish to look at a simple moving average of the futures because you probably know better than I do. Maybe 7% of all futures trading, I'm sort of talking the S&P, occurs in the overnight session.
right,
93% of it, or whatever the number is, occurs from 9:30 to 4.
right,
So if you're assigning equal weight, which is what time does, to all those overnight periods, you're flawed. They don't deserve the same weighting. So
right.
instead, when you're using the volume weighted average price, it normalizes that overnight says, and it says because there was less volume here, it's not going to move as much. It's just not as important. But we take the average of all those together, and that's why we see the 9:30 a.m. and the overnight session converge often within that first 30 minutes of the day because the insignificant overnight volume has now been absorbed by the regular trading hours, New York Stock Exchange regular trading hours.
Exactly. Exactly. You know, I completely agree. And I mean, from holistically, it's just the average price. You know, it's as simple as the VWAP is ample price as average price, right? Oh, what's the
Yep.
average price? Well, it's a little more complicated, right? But it makes sense when, you know, when you put it in those terms why it's so important. Brian, I think we're running a little bit up against time. I
Sure.
do want people to know where to find you because I think you know, if they can, you know, find your book on Amazon, if they could, you know, see what you're putting out on the socials or go to a website, that, you know, people would be very um, um, happy to do that.
Yeah. The main thing I use is Twitter or X, whatever you want to call it these days. It's at Alpha Trends. Um, if you're not a Twitter X user, then I do a weekly video on YouTube. Actually, I do them on Wednesdays as well, where I go over a lot of these concepts educationally with the current market. So that's a great way to look at it. And if you want to dig even deeper, yes, the books are on Amazon. Just search my name, and I've got alphatrends.net as well. So um, it's pretty easy to find me.
And I'll say, you know, the book again, really great read, really understandable. I don't know, Brian, when you got your CMT, probably like me a while ago, where you had to buy all the books rather than now
Right.
they're in one book, right? And those books were expensive. I mean, some of those books now they're great, right? But your book isn't, you know, your book for a textbook. I found it really, you know, wow, this is really an affordable price. Like you aren't beating the bank down. I was like, you know, this is really valuable book. So we're going to give one away thanks to your generosity to viewers who want to just send us an email, learn at ninjatrader.com, put AVW am I doing it right? AVWAP into the subject line by Monday end of day, and we will pick one lucky winner to send the book to. And again, that's thanks to the generosity of Brian here for providing that book. I can't recommend it enough. So appreciate that, Brian, and thank you for coming on.
My pleasure. Sorry I was late too. I apologize for that.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.